Welcome to the Opening Bell Report.
Today we're looking at an analysis of SoFi's recent stock surge, which is projecting a $25 price target after their Q4 earnings.
It's a bold call. Let's dive in.
Okay, so a key theme, really the foundation of this piece, is the valuation logic, specifically this idea of multiple expansion.
Right.
The analysis seems to really hang on the idea that the market will re-rate the stock from a bank multiple to a tech multiple.
And that's the whole ballgame, isn't it? It's a fascinating place to start because it gets right to the tension in SoFi's identity.
How so?
Well, the report notes a 54 times PE and compares it to best-in-class SaaS companies. They mention Palantir, CrowdStrike.
The heavy hitters.
Exactly. And I get the temptation there. But the weakness is that the link between a fintech bank and a pure-play SaaS company is what's pretty tenuous.
Right.
And just saying if the market decides it's just too passive. It sounds a bit like wishful thinking, not a real projection. We need to tell the market why it should decide that.
Yeah, it's a bit like saying, I'm an athlete because I wear sneakers, but you haven't actually proven you can run the race yet.
That's a perfect analogy. So the suggestion here is to really strengthen that argument. Isolate the specific revenue segments that actually justify a tech multiple.
Get more granular.
Way more granular. I mean, what if we looked at it from a sum of the parts valuation? It's a standard tool for a hybrid business like this.
So break it down piece by piece?
Yes. Instead of a blanket comparison to Palantir, look at the revenue. It's $1.03 billion. Okay, but what percentage of that comes from the technology platform versus the lending segment?
Because a dollar from software isn't the same as a dollar from interest on a loan.
Not to Wall Street, it isn't. So here's the concrete step. Value the banking operations at a bank multiple. Say Ally's 11 times earnings. Be conservative.
Okay.
Then you take the technology platform revenue, and that's where you apply a real SaaS multiple. Maybe not Palantir's, but something strong.
So you're building the stock price from the ground up, brick by brick.
Precisely. And if that math, the boring bank part plus the exciting tech part, gets you to $28, you suddenly have a defensible arithmetic argument, not just a feeling.
It anticipates the skeptic who just says, but they're a bank.
You're agreeing with part of their argument and then showing them why they're wrong about the other part. You could also dig into that 30% EBITDA margin they mention.
It's highlighted as a key differentiator.
It is, but we need to explain why it justifies a premium. A 30% margin in software is a totally different quality of earnings. It scales, it's sticky.
It's not capital intensive in the same way.
Not at all. And if you can show the margin expansion is driven by the tech side, you've moved the argument from SoFi looks like a tech company to SoFi earns money like one. That's much harder to argue against.
That's a much stronger foundation. Okay, let's move on. The bear case. The critique here is that it leans too heavily on technicals and macro stuff and kind of ignores the company's specific risks.
This is such a common trap. You feel like you have to include a bear case to look balanced, but you end up pulling your punches.
Right. The report cites an overbought RSI and Fed rate hikes. I mean, sure, those are risks, but they feel safe, cursory.
It's like that job interview answer, where your biggest weakness is that you work too hard.
Exactly. Or I care too much.
Any serious investor knows RSI is a short-term signal, not a fundamental flaw. By ignoring the real operational risks, it actually feels a bit promotional.
It makes you wonder what's being left out.
It does. So the suggestion is to bolster the bull case by actually acknowledging and then refuting the really hard-hitting risks. You have to scare the reader a little to make them feel safe.
Stress test the thesis.
You have to. For instance, what about the credit environment? It's a bank. A much stronger bear case would analyze the risk of loan defaults, especially in their personal loan portfolio.
Unsecured loans. If the economy turns, that's where the pain starts.
That's a real, tangible risk. So you address that head on. You say, yes, personal loans are risky, but here's SoFi's borrower profile. High FICO, high income. You raise the fear, then you neutralize it.
And what about that growth number? The 38% revenue growth.
It's an amazing number. But is the connection between that growth and the cost to achieve it fully explored? I'd want to see a discussion on sustainability.
Is it expensive growth?
Maybe. You have to mention customer acquisition cost, CAC. If they're growing at 38% but their CAC is doubling, that's a huge red flag for the whole profitability story.
It turns it from a vanity metric into a real unit economics discussion.
Exactly. And instead of just saying, Fed hikes, talk about how interest rate volatility affects their net interest margin, their NIM. That's the kind of specific risk analysis that makes a report feel professional.
Okay, I really like that. Be your own toughest critic. Now, shifting gears. Market mechanics. The the short squeeze potential.
Ah, yes. The favorite narrative of the internet era.
The report says 12% short interest plus a breakout over $21 adds fuel to the fire. The critique is that this sounds, well, a little sensationalist.
I have to agree. 12% is elevated for sure, but it's rarely enough for a true mechanical squeeze. Framing it that way, it appeals to hype.
It sort of cheapens the fundamental work, doesn't it?
It does. It moves it from an investment thesis into
A lottery ticket.
right. And it's a shame because the data point is bullish, just not for that reason.
So the suggestion is to reframe it. Focus on short covering a structural support, not an explosive squeeze.
Completely. Change the headline from short squeeze potential to something like liquidity and support levels. That sounds like real analysis.
How would you explain that?
You explain that as shorts cover, they become natural buyers. They're forced to buy the stock back. That provides a floor, reducing downside volatility. It's a safety net, not a rocket ship.
And are there better metrics to use?
Absolutely. You could look at the days to cover ratio. You calculate it based on average daily volume. If volume is high, like after earnings, that 12% short interest might get absorbed in a day or two.
Right. If everyone's rushing for the exit, but the door is 10 miles wide, there's no panic.
That's a perfect way to put it. Analyzing that volume absorption is just so much more rigorous than hoping for a squeeze.
It's relying on math, not on other people making a mistake.
And you can also contrast it with historical levels. If short interest was 20%, the fact that it's down to 12 shows the bears are already giving up. That's a much stronger sign of a sustained rally.
That makes a lot of sense. Okay, final section. Competitive benchmarking. The argument is that the comparison between SoFi, Affirm, and Ally Bank, it lacks nuance.
This is the Goldilocks problem. The report gives you two extremes. SoFi is either Ally at a boring 11 times PE, or it's Affirm at a sky-high 88 times PE.
And then says if SoFi were like Affirm, it would be $34.
Which is a massive range. It's like saying, if I were as fast as Usain Bolt, I'd win the race. But if I were a turtle, I lose. It doesn't tell me how fast I actually am.
Right. So where does SoFi actually land on that track?
Exactly. The suggestion is to introduce a hybrid multiple concept. Acknowledge that SoFi sits somewhere in between.
How would you find that?
You could identify a peer group that sits between legacy banks and pure fintech. Maybe look at other digital-first banks globally, like a new bank, to find a median PE. Maybe that's 25 or 30 times. That makes your $25 target feel much more grounded.
And it would also be important to explain why Affirm gets that 88 times multiple.
Crucial. You have to acknowledge why they're different. Maybe a firm has higher growth velocity or a different regulatory environment. You explain why SoFi shouldn't trade that high, but then explain why it definitely beats Ally. It's about triangulation.
Is there a single metric that could unify these different models? It feels like comparing apples and oranges.
There is, actually, the Rule of 40.
Walk us through that.
It's a classic SaaS metric. You just add the revenue growth rate and the profit margin together. Anything over 40 is considered elite.
So for SoFi,
You take their 38% revenue growth, add their 30% EBITDA margin, and you get a score of 68.
which is
Stratospheric. Now you compare that 68 to Affirm and Ally. Ally has margins, but almost no growth. Affirm has growth, but thinner margins. If SoFi's combined score is superior, that's your argument for a premium valuation right there.
it's a much more sophisticated way to benchmark. You're not comparing business models, you're comparing the quality of the business itself.
You got it. It stops being about hype and starts being about a calculation.
This has been incredibly thorough. It feels like we've given this report the tools to go from being exciting to being deeply persuasive.
I think that's right. The raw materials are all there. The growth, the profitability. But to convince someone that $25 is next, you have to move past the celebration and into the calculation.
Well said. So to wrap this up, let's summarize the actionable takeaways. First, on valuation.
Don't just wish for a tech multiple. Quantify it with a sum of the parts analysis to build your price target from the ground up.
Second, the bear case. Deepen it. Tackle the hard stuff. Loan defaults, CAC trends, MIM sensitivity. It builds trust.
Third, on the short squeeze. Tone it down. Reframe it as short covering support. Use days to cover to show structural stability, not speculative volatility.
And finally, on benchmarking.
Avoid the binary choice. Use a hybrid multiple or the Rule of 40 to show why SoFi's score of 68 justifies a premium, no matter what label you put on it.
We'd love to see where you take this. Refine the analysis with these deeper data points and feel free to resubmit it.
Don't forget to like, share, and subscribe for more.